In this session, I would like to give a very brief overview of the options market. It's a very high level overview, basic understanding of the options market. And what we see is even this is a derivative, right? Which means it is an agreement between the two parties to buy or sell some asset in future at a particular date in future and for a price that is being agreed upon today. So this is the entire thing, which is similar for any kind of a derivative contracts. There is an agreement, and the only difference between probably a future which gets traded on the exchange with a similar kind of a framework and an option is, for every option contract there is a holder of the option and there is a writer of the option. One party writes the option, the other party holds it. Or probably a better word is, one is a buyer of the option, one is the seller of the option. Or we can say one is long on the option, one is short on the option. Whatever are the terms. Here, the only difference is the holder, the buyer, the long position in an option, he is not obligated to trade. This position is not obligated to trade. It's an option to trade. If he really wants to trade on the future date for the agreed price, he can do it. Otherwise, he can very well back out of the trade. Whereas the party who is the writer of the option, it is mandatory or it is obligatory for him to trade in case the holder wants it. If the holder wants to trade, the writer has to trade. If the holder is backing out, the writer has nothing else to do. And what we see is, in the majority of the cases, just like futures contracts, options are also majorly short term. They can happen almost on any of the assets. We see the options on stocks, we see the options on bonds, we see them on indexes, we see options on currency, we see options on interest rates. So you can think of on any instrument, probably the on any underlying, we see options being heavily traded. So majority of the time they are short term with maturities generally less than a 1 year period. And just to give a brief understanding, we find two types of options. One is a call option, the other is a put option. So here, just defining the roles again, for every option we said there is one holder, there is one writer. So the holder of the option, he is having an option to buy. Option to buy the underlying asset at a future date. Whereas in case the holder wants to buy it, the writer is obligated to buy, obligated to sell, because the holder wants to buy the security at a future date for a specific price. So the writer is obligated to sell. Whereas in case of a put option, the holder versus the writer, the holder is having an option or a right to sell the asset at a future date at an agreed upon price. So if he wants, he can sell it, otherwise he can very well back out of the contract. Whereas in case the holder wants to sell it, for the writer it is an obligation to buy. So that's the reason we see in case of option, we see four important positions coming up. We talk about buying a call. Buy is similar to holding a call. So we are talking about buying a call option or selling a call option. Sell is same as the writer. Selling a call. Similarly, I can talk about buying a put or holding a put, selling a put or writing a put. So these are the four major things that come out as a part of any option transaction. And the price at which the underlying asset would be bought or sold or agreed upon for buying or selling is what we call as an exercise price, or in some cases people even call it as the strike price. So this is the typical price for which the underlying security can be sold by the writer of the call to the holder of the call, or by the holder of the put to the writer of the put, right? And for giving the right to one party, right, this person is taking a risk, the writer is taking a risk by giving the holder an option. Here also the writer is taking a risk by giving an option to the holder. So the holder will make an upfront payment of some amount to purchase that right or option. That is what we call as the premium. So it's not like a margin, which it's not a caution deposit, right? Margin we have seen earlier, it's more like a caution deposit which both buyer and seller deposit with the exchange. But here this premium is an outright payment from the holder of the option, buyer of the option, to the seller of the option for getting that additional right in terms of backing out whenever the person wants, right? So it is a kind of a non-refundable kind of an amount that a buyer of the option is paying to the seller of the option. So in case the holder is willing to get into the contract, otherwise called as exercise the option, then in addition to whatever the premium that has been paid at the beginning of the contract, the exercise price would be paid on the expiration of the contract. So the total payment that the holder of the option is paying to the writer in case of a call option is the premium plus the exercise price. Whereas in case of a put, the holder has already paid a premium to the writer. So when he is selling the asset, he is still selling it at the exercise price. So the net that he is getting is the exercise price minus the premium, because he has already paid a premium to the writer for giving him the option to decide whether he wants to sell or not. In case he has got the option, so he has paid a premium fee. So in case he is trying to sell the underlying security at the exercise price, what he is finally left with is exercise price minus the premium. So in case we are not exercising the option, then probably it's only the lost premiums. For the holder, it's the lost premium because he is not going ahead with the deal. So whatever the premium amount is not refunded, so he has lost that premium. And for the writer, it is the premium that it is the gain for him. So that's a very brief thing about the options contract. And when we talk about the options that are typically exchange traded, majorly it is similar to that of the futures itself. There is an open outcry process more similar to that of futures, and there is even an electronic settlement kind of a process. And there is a clearinghouse where the role of the clearinghouse is more and more similar to that of what we have discussed as a part of the futures. That's a party to every trade. The only difference here is the margins. In case of options, they need to be deposited only by the writers or the seller of the option. The buyer of the option need not deposit the margin because the buyer of the option has literally paid the premium to the seller of the option outright. So he has the right to break the contract. So, because it is his right or he has the option to break, there is nothing credit risk that is associated from the buyer's perspective. So, that's the reason buyer need not deposit any kind of a margin. Only the seller or the writer needs to deposit the margin. Whereas in case of futures, we have seen both the buyer and seller have to deposit the margin. That's one major difference. And just like the futures, what we see is majority of the option positions are offsetted even before the maturity date itself. So they are closed out by an exactly equal and opposite transaction, and which works more or less on the similar lines as that of the futures only. So this is a broad high level overview of the options market. In case you have any further queries regarding the same, you can get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.